For nearly a decade, the narrative surrounding real estate investment was deceptively simple. Acquire property, leverage cheap debt, and watch as rental income effortlessly covered the mortgage while equity compounded in the background. It was the era of the passive income landlord, fueled by historically low interest rates and a chronic housing shortage that drove rents up by double digits year over year. But in the current economic cycle, that narrative has fractured. The easy money is gone, and the fundamentals of cash flow investing are being tested in ways we haven't seen since the great financial crisis. What we are witnessing right now is a rental yield compression in specific, high-growth markets. The explosive rent growth of the previous cycle has not only stalled, it has reversed. Vacancy rates in key metropolitan areas are climbing, forcing landlords into a brutal competition for qualified tenants. At the same time, operating expenses, property taxes, insurance premiums, and maintenance costs are surging. This is squeezing net operating income, NOI, from both ends, turning what were once cash-flowing assets into monthly liabilities. This isn't a nationwide phenomenon yet. It is a localized crisis hitting 9 specific markets where speculation outpaced economic reality. If you own rental property in one of these cities, or if you are considering entering these markets looking for deals, you need to understand the structural headwinds you are facing. The data suggests that for many investors who bought at the peak, the math simply no longer works. But there is a hidden factor driving this collapse that goes beyond just supply and demand. In market number 4, we will reveal a specific type of shadow inventory that is about to flood the rental market, potentially driving rents down another 15% before they stabilize. Understanding this supply shock is critical for protecting your portfolio. Number 9. Boise, Idaho. We begin with the city that became the cautionary tale of the post-pandemic era. Boise was the ultimate Zoom town. During the migration boom, rents in Boise skyrocketed as remote workers from coastal cities arrived with high salaries, willing to pay premium prices for single-family rentals. Investors chased this yield aggressively, buying up starter homes and converting them into rental portfolios, banking on the assumption that the migration would never end. However, in the current market, the remote premium has evaporated. As corporations enforce return-to-office mandates and the migration flow reverses, the demand for high-end rentals in Boise has cratered. We are seeing rental listings sit on the market for 60 to 90 days, forcing landlords to offer significant concessions, free months of rent, waived deposits, just to get a tenant signed. Simultaneously, a massive wave of multifamily supply that broke ground 2 years ago is now delivering units. This new supply is undercutting the individual landlords who bought single-family homes at the peak. If you bought a rental in Boise expecting the rents of the previous cycle, your pro forma is now broken. You are likely cash flow negative, subsidizing your tenant's housing cost every month out of your own capital reserves. This is a classic case of supply shock. The market is flooded with inventory just as the primary demand driver, remote work migration, has been turned off. Now that you understand how a supply shock can devastate a small market like Boise, you must see how that same dynamic plays out in a much larger, more complex economy. The next city isn't just dealing with too many apartments. It's dealing with a fundamental shift in its primary industry that is driving high-earning tenants away. Number 8. Austin, Texas. Austin was the crown jewel of the Sun Belt boom. It was pitched as the new Silicon Valley, attracting tech giants and thousands of six-figure earners. Rents in Austin exploded, and institutional capital poured billions into the city, assuming that the tech migration was permanent and exponential. But the data in the current cycle paints a grim picture for landlords. The tech sector has entered a period of contraction and efficiency. Layoffs and hiring freezes at major employers have reduced the pool of qualified tenants who can afford luxury rents. At the same time, Austin has one of the most aggressive construction pipelines in the country. Thousands of new units are coming online every quarter. The result is a brutal concession war. Class A apartment buildings are offering up to 8 weeks of free rent to attract tenants. This forces individual landlords, who cannot afford to give away 2 months of revenue, to lower their base rents significantly to compete. We are seeing year-over-year rent declines in the double digits in some neighborhoods. For investors who bought with variable rate debt or who syndicated deals assuming 5% annual rent growth, this is a crisis. The revenue isn't there to cover the debt service. We are already seeing signs of distress in the multifamily sector, and this pressure is trickling down to the single-family rental market. However, while Austin struggles with oversupply, the next city on our list faces a different kind of threat. This next market is experiencing a regulatory squeeze that is making it legally difficult for landlords to operate profitably, regardless of demand. This is a risk factor that most out-of-state investors completely overlook until it's too late. If Austin's tech-driven reversal was a supply-side shock, the next city on our list represents a crisis of operating costs. We are shifting our focus to a region that was once the ultimate haven for cash flow investors. A place where low taxes and high demand created a perfect environment for rental portfolios. But in the current cycle, a new, almost insurmountable expense has emerged that is destroying the profit margins of even the most seasoned landlords. Number 7. Cape Coral, Florida. For years, Cape Coral was a magnet for retirees and remote workers seeking sunshine and affordability. It became one of the fastest-growing rental markets in the country. Investors flocked in, buying up single-family homes with the expectation of steady appreciation and reliable rental income. The math worked beautifully when insurance premiums were manageable. But today, Cape Coral is ground zero for the insurance apocalypse. Following a series of devastating hurricane seasons, insurance premiums in Southwest Florida have not just increased, they have tripled or quadrupled. Landlords are seeing annual premiums jump from $2,000 to $8,000 or even $12,000 in the current renewal cycle. This is a direct hit to net operating income, NOI. Unlike a mortgage payment, which is fixed, insurance is a variable cost that can explode overnight. For many investors, this increase wipes out their entire annual cash flow. They are now holding assets that generate negative returns. To make matters worse, they cannot simply pass these costs on to tenants because the rental market is softening. Demand has cooled as the cost of living rises, and tenants are hitting their affordability ceiling. As a result, we are seeing a flood of distressed listings from landlords trying to exit the market. They are desperate to sell before the next insurance hike or the next storm. But buyers are wary. They see the insurance costs and demand a lower purchase price to make the numbers work. This is driving property values down, leaving many landlords with shrinking equity and negative cash flow. But if you think the insurance crisis is the only thing sinking Florida markets, you haven't seen what is happening in the next city. While Cape Coral struggles with natural disasters, our next location is dealing with a man-made disaster of over-leveraged institutional capital. This next market is drowning in inventory due to a failed Wall Street landlord experiment. Number 6. Jacksonville, Florida. Jacksonville was supposed to be the stable, affordable alternative to Miami or Tampa. It attracted massive institutional capital, hedge funds, and private equity groups, who bought up thousands of single-family starter homes to turn them into rental portfolios. They bet big on endless population growth and perpetually rising rents. That thesis has failed in the current market. Jacksonville is currently experiencing a rental glut. Developers built thousands of new apartment units and build-to-rent communities at the exact moment migration started to slow. Now, landlords are forced to compete for a shrinking pool of qualified tenants. We are seeing rent concessions everywhere: 2 months free, 0 deposit, gift cards. When institutional landlords start cutting rents to fill vacancies, mom-and-pop investors get crushed. They cannot compete with the marketing budgets or the pricing power of large corporations. They are forced to lower their rents to unsustainable levels just to keep their units occupied. We are seeing investors who bought at the peak based on projected rental yields now underwater. They can't cover their debt service with the lower rents, so they are forced to sell. This wave of institutional selling is hitting the market just as regular buyers are pulling back due to high interest rates. It is a double whammy of supply. Jacksonville is watching its rental yields compress as the institutional model cracks under pressure. Now that you understand how institutional oversupply impacts a market like Jacksonville, you must see how a different kind of saturation is affecting the next city. This next market isn't just dealing with long-term rentals. It is facing a collapse of its short-term rental economy that is flooding the market with desperate landlords. Number 5. Nashville, Tennessee. Music City was one of the hottest real estate markets in the country for a decade. It became the "it city" for bachelorette parties, corporate relocations, and entertainment industry growth. Rents in Nashville skyrocketed, pushing the cost of living well beyond what the local service economy could support. Now, the affordability crisis has hit a wall. The local workforce, the musicians, teachers, and service workers who make the city run, has been priced out entirely. They simply cannot afford the rents that investors require to make their numbers work. Simultaneously, we are seeing a massive glut of short-term rentals converting to long-term rentals. Investors bought condos specifically for the tourism market, banking on high occupancy and daily rates. But as travel budgets tighten in the current economic climate, tourism revenue is softening. Those units are sitting empty, forcing owners to pivot to the long-term market. This sudden influx of furnished high-end rentals is flooding the inventory, driving down prices for everyone. Landlords who bought based on short-term rental income are finding that long-term rents are 30% to 40% lower. The math doesn't work. They are cash flow negative and facing a difficult choice: sell at a loss or bleed money every month. However, while Nashville struggles with short-term rental saturation, the next city on our list faces a much deeper structural issue. This next market was the darling of the pandemic era, but now faces an inventory crisis that experts say will take years to absorb. The Zoom town, bust here, is a warning sign for real estate investors nationwide. If Nashville's Airbnb collapse was a warning sign, the next city on our list represents a blaring siren for long-term investors. We are entering the territory of true capitulation. These are markets where the decline isn't just a correction. It is a full-blown crisis that is wiping out projected cash flow in months. We are traveling to the heart of the tech triangle, to a city that became the poster child for innovation, but is now serving as a warning to the rest of the nation. Number 4. Raleigh, North Carolina. Raleigh, part of the research triangle, was hailed as the future of biotech and tech innovation. It attracted thousands of high-income earners and saw rents skyrocket as demand overwhelmed supply. It became a landlord's market on steroids. But in the current cycle, that dynamic has reversed violently. Raleigh is now ground zero for the apartment oversupply crisis. Developers, banking on endless tech migration, flooded the market with thousands of new luxury units. Now, they are stuck with high vacancies and falling rents. The tech recession of the last year has hit hard. Startups are failing, funding rounds are drying up, and the high salaries that justified these rental prices are disappearing. We are seeing a spike in rental concessions among white-collar workers. Landlords who bought properties assuming they could charge $2,500 a month are finding that the market will only bear $1,800. This $700 gap destroys cash flow. For investors who used leverage, this means negative amortization. They are paying out of pocket to keep the property. Furthermore, the single-family rental market is being hit by a wave of accidental landlords. Homeowners who tried to sell, couldn't get their price, and decided to rent instead. This shadow inventory adds even more supply to an already saturated market. Raleigh is learning the hard way that a tech hub economy is only as strong as its job growth. When the jobs stall, the rents fall. But if you think the tech fallout is bad in Raleigh, wait until you see what is happening in the next city. We are moving to a place that became the symbol of American excess, a city where the rental market wasn't just a bubble. It was a mirage. And the desert heat is finally evaporating the demand. Number 3. Phoenix, Arizona. Phoenix was the ultimate pandemic boomtown. It saw some of the fastest rent appreciation in history. People moved from California in droves, bringing coastal salaries and bidding up rents 30%, 40%, sometimes 50% year over year. Builders responded by constructing thousands of new apartment complexes in the desert, assuming the migration would never end. They were wrong. In the current cycle, Phoenix is facing a massive inventory glut. The California exodus has slowed significantly as companies call workers back to the office or as remote workers realize that Phoenix summers are brutal. At the same time, the local economy is cooling. Construction jobs, which fueled much of the recent growth, are drying up as new projects get canceled. We are seeing rent cuts on new construction that are staggering. Landlords are desperate to fill units before carrying costs eat their margins. They are offering 3 months free rent, waived application fees, and even gift cards to sign a lease. But even with these deals, units are sitting empty. The single-family rental market is frozen. Investors who bought at the peak are now competing with thousands of new apartments. They are forced to lower their rents to unsustainable levels just to keep their properties occupied. Phoenix is a stark reminder that when you build too much in the desert, eventually the demand dries up. However, while Phoenix struggles with oversupply, the next city on our list faces a much deeper structural issue. This next market was once the most expensive rental market in the country, but is now watching its tenant base flee in droves. The tech exodus here is reshaping the entire rental landscape. Now that you understand how oversupply can crush rents in a desert city like Phoenix, you must see how a collapse in quality of life can drive tenants out of a coastal metropolis. The next city is not dealing with too many apartments. It is dealing with too few people who want to live there. If Phoenix's desert bubble burst was a regional shock, the next city on our list represents a systemic failure that reverberates across the entire rental landscape. We are moving to the West Coast, where a once unrivaled economic engine is sputtering under the weight of its own success and mismanagement. This city proves that even with massive natural advantages, a rental market can crack under excessive pricing and quality of life deterioration. Number 2. San Francisco, California. San Francisco was once the most expensive, exclusive rental market on Earth. It was unstoppable. Landlords could command $4,000 for a studio apartment, and prospective tenants would line up around the block. But today, the narrative has completely flipped. The combination of permanent remote work, a massive homelessness crisis, and an exodus of major retailers has decimated the city's appeal. Downtown office towers are sitting 30% vacant, destroying the local tax base and small businesses. But the rental market is where the real pain is. We are seeing luxury apartment buildings offering months of free rent to attract tenants. Landlords are desperate. They are slashing prices by 20%, 30%, sometimes even 40% from the peak. The tech exodus is real, and it is draining the wealth from the city. Even single-family rentals in desirable neighborhoods are sitting vacant for months. San Francisco proves that no market is invincible. When quality of life degrades and costs become prohibitive, people leave. And when the high-income tenants leave, the rental market crashes. Landlords who bought at the peak are now underwater on their cash flow, subsidizing their properties every month. But if you think San Francisco's challenges are daunting, wait until you see the absolute collapse happening in the next city. While San Francisco struggles with quality of life, this next city is facing a supply glut so massive that it threatens to bankrupt an entire generation of real estate investors. Number 1. Huntsville, Alabama. Huntsville is the shocker on this list. It was the darling of the real estate investment world for years. Touted as the Silicon Valley of the South due to its massive aerospace and defense industry, investors flocked in. They were told it was recession-proof. They were told rents would only go up. But in the current cycle, Huntsville is drowning in inventory. Developers built thousands of new apartment units and single-family rentals, anticipating endless job growth. While the jobs are still there, the supply of housing has vastly outpaced the demand. We are seeing vacancy rates in new construction hitting 20% or higher. Landlords are engaged in a race to the bottom. To fill units, they are cutting rents aggressively. Class A apartments are now competing with Class B prices. This crushes the mom-and-pop investors who own older rental properties. They cannot lower their rents enough to compete with brand-new buildings offering amenities and concessions. Huntsville is a classic case of field of dreams investing. If you build it, they will come. But they built too much, too fast. Now, the market is oversaturated, and landlords are paying the price. So let's jump into conclusion. The strategic pivot for landlords. So, what does this mean for you as a real estate investor? If you own rental property in one of these 9 markets, you are navigating a treacherous economic landscape. The risks to your cash flow and equity are real and growing. However, this does not mean you should panic sell. Instead, it requires a strategic pivot. First, focus on retention. It is far cheaper to keep a current tenant than to find a new one in a softening market. Be proactive. Offer lease renewals early. Consider small upgrades or concessions to keep good tenants happy. A vacancy month costs you far more than a $50 rent reduction. Second, Audit your expenses. In a market where rents are flat or falling, the only way to protect your net operating income is to control costs. Review your property tax assessments. Appeal them if values have dropped. Shop your insurance policies. Defer non-essential capital expenditures until cash flow stabilizes. Third, be realistic about your numbers. If you are buying today, do not underwrite rent growth for the next 2 to 3 years. Assume rents will be flat or slightly down. Ensure the property cash flows today, not based on future projections. Finally, remember that every crisis presents an opportunity. While these specific markets struggle, others will thrive. By identifying the winners and losers early, you can position your portfolio to capitalize on the shifting economic landscape. The days of buy anywhere and profit are gone. We are back to the fundamentals of real estate: location, supply, and demand. The rental market map of the United States is being redrawn. Don't be left holding a vacant unit on the wrong side of the border.